Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Well, it's officially November. It's Tuesday, the 2nd of November, 2021. Yes, the year end is quickly coming upon us and holiday seasons are here. So I hope you're ready for Thanksgiving and the holiday season as we close the year out. But in the meantime, let's talk about what the markets are paying attention to. We are too at Blanke Schein Wealth Management for our clients, and thanks for watching. So today, let's talk about what markets are paying attention to as we normally do. But today is the most anticipated Federal Reserve meeting. It's a 2-day meeting kicking off today. Tomorrow afternoon, we're actually going to get the Fed announcement as to sort of the results of the conclusion of their meeting. But this is the most important meeting because this is that moment in time where the Federal Reserve has broadcast very clearly, has communicated very distinctly the fact that they're going to stop the bond purchases of $120 billion per month, and they're going to slow that down. It's part of the two-step approach. One is the bond purchases to support the market, provide liquidity, as they did in the last sort of 2 years to provide assistance as we went through and bridge the gap of the global pandemic, if you will. That being said, what we're also going to be paying attention to is sort of what the Fed is now indicating in terms of higher rates, as they'll indicate that the end of the bond purchases will also not be correlated to or corresponding to interest rate hikes. Those are completely two separate things according to the way the Federal Reserve looks at it. So we'll be paying attention to that. And finally, as we look at the Fed has a dual mandate, right? Full employment for the economy and to stay ahead of inflation. As we know, the Federal Reserve has quite clearly stated that they're going to allow inflation to run hot or run higher than normal expectation, which is 2% for them. And if you look at our inflation report last Friday, it's a 30-year high. I mean, literally, we had a 4.4% basically year-over-year inflation read, and that's a 30-year high going back to 1991. And it's incredible that the Federal Reserve is now saying, hey, listen, inflation is transitory. It's not an issue, but it kind of is going to be an issue. But so they're allowing that to run hot because their first focus right now is the economy getting back. More importantly, that the employment number gets better and it starts repairing itself across the United States. And so we're going to watch and see what the Federal Reserve actually discusses as it relates to that. And it's going to be interesting to see how that plays out. But let's talk about earnings right now. The third quarter, we're over 50% of the S&P 500 have reported earnings to date of their third quarter results. And there's good news. I mean, we're seeing on average over a 39% cumulative growth of earnings year over year for the S&P 500, number one. But number two is over 82% have beaten and over 4% right now are in line. So you're about an 86% doing better than average and also guiding higher for 2022. Now, 2022, we got a lot of unknowns, right? We don't know what the new tax policies are going to, whom they're going to affect, whether it's going to be corporations or individuals, and that's going to have a drag on earnings. So will the Federal Reserve as they raise interest rates potentially. That'll have a drag on earnings. And then as we get through sort of these inflationary pressures and all of the supply chain issues and margin compression and so on and so forth, Wall Street always, the markets always climb a wall of worry, and that's what we're seeing. Markets are still grinding higher and they're creating all-time highs, which is amazing. The reason why is we want to make certain that the Federal Reserve is sort of being more accommodative than or more dovish than hawkish, if you will, as well as earnings continue to drive markets, and they're continuing to do so as we anticipate that. Now, today is election day. There's two main basically events, if you will. There are gubernatorial races in Virginia and New Jersey, and so I think Virginia is taking center stage right now. Now, in the history of tradition, if you will, the party that wins the White House the following year, if you will, or the following election, traditionally is the opposite. So in this case, we have the Democrats winning the White House. So Republicans could win Virginia. I mean, that's sort of been the history, if it's ever our guide. But what's more important is whatever succeeds is sort of going to be the narrative on a go-forward basis, springing us into 2022. And that's going to be, again, it's a midterm election cycle, which has implications for Congress. And so if we get a divided House like we did in '94, where Newt Gingrich came in and the Republicans came in, we could see something like that play out. And it's not a far stretch, simply because I think what we're seeing right now with the stalling of the current sort of Build Back Better proposal from President Biden and his policies, it's potentially in jeopardy. And there's a lot of underlying factors specific to everyone on their kitchen table, but I think a lot of sort of discord is playing out right now. And that can sort of spill over into 2022 in different sort of regions and states and around the United States, and sort of bring it back to level and have sort of the Congress be a divided House, if you will, and the White House being Democrat. So in that case, we saw 94, and Newt Gingrich took over in the sort of House of Representatives and sort of stopped the Bill Clinton agenda. And really why that was important is because what that was a signal for markets is that the Congress can't continue to spend money like a drunken sailor, without regard to how it's going to get paid back, or if at all. And so what happened then after that, markets liked that idea. And from 95 to 99, we had 27% on average rate of return for the S&P, if you were to look back then, which is tremendous. So this could set up, who knows if that's actually going to play out. But having a divided Congress is not a bad thing, historically speaking, for equities, simply because that just means that we're sort of fiscally being more responsible than just spending a bunch of money and not worrying about our kids and great-grandkids paying it back. So that's the importance of today's election in across the United States, especially in Georgia, or Virginia, excuse me. And we'll pay attention to that. And I think, Atlanta, we're going to see, I think, the World Series we have later tonight. So we'll pay attention to that. But that's our update today, and we'll go from there. Thanks for watching. Take care. Bye-bye.